Good afternoon, everyone, and thank you very much for joining us, especially if you joined us on Wednesday and I've had to tune in again. We're really grateful for your patience. We've dealt with the technical issues and we are now hopefully going to show you some really interesting stuff. Miton UK MicroCap is quite a special trust which uses the unique advantages of the structure to invest in the UK's smallest companies, offering exposure to real domestic players at a time when there's much talk of onshoring and the deglobalization of the world in the wake of COVID and the supply chain problems that the pandemic revealed. Joining us today is the fund manager, Gervais Williams. He predicted this phenomenon in his book called The Retreat of Globalization back in 2016. I'm looking forward very much to hearing his views on the outlook today for British companies in a post-Brexit, post-COVID, we hope, environment, particularly as we absorb the latest news from the Chancellor's office and consider its implications for UK PLC. Gervais, over to you.
Thank you very much, Pascal, and thank you again. As Pascal said, if you joined on Wednesday and you didn't get through, I'm so sorry. We have now resolved the technical issues. Anyway, if you move to the next slide, Pascal, what we've got there is some outlines of some of the risks. These are funds which are involved in investing in equities. Their prices can go down as well as up. So if we go to the slide, myself and Martin have set this fund up back in 2015. Specifically, it was investing in quoted companies, all quoted companies, no unquoted companies, at the smaller end of the market cap range. Many of these businesses are 100 million market cap or bigger, but most particularly, they're only small relative to Shell. Many of these businesses in themselves are actually large businesses employing thousands of people, often with international operations. So although it's called a microcap trust, it's the nature of the companies which are small and agile compared with the mainstream stocks. If we move to the next slide, slide 5, what is interesting about the universe in which we invest is that the UK stock market is quite different from most other global stock markets. If you look at inflation on the left-hand side, about 4.5% per year since 1955. And what's been interesting, particularly over the last 30 years, is that mainstream stocks have done really well. They've outperformed inflation. They've risen progressively. And so if you look at the Numis UK Large Cap Index or the Numis All Share Index, what you can see is they produced a return some 7% better than the inflation period. If you'd looked at this 30 years ago, actually, they would have been much more similar. It would have outperformed, but not by much. And so the advantage of investing in the NSCI, the Numis Small Companies Index, which is the bottom 10%, is that you can get better returns, around a 33% extra return, about 10% above inflation since 1955. And of course, the NSC, the Numis Small Companies 1000, which is the microcap index, really the bottom 2%, which is where this fund specializes. And that fund, that part of the stock market has risen by about 12% per year, better than the inflation. And I say that's been boosted in part by the long period over the last 30 years where globalization has driven up the valuation of all assets. So what's interesting about the fund isn't so much, if you move to the next slide, isn't so much that it's investing in the microcaps. It means the companies themselves are very different from the mainstream companies. What you can see here in the trust is that around 17% is invested in information technology companies. These are often companies which are either about to generate cash, already generating cash. So it's a bit different, perhaps, some of the US unicorns. And then you can see there's other sectors, materials, industrials, and energy. So the key issue is that the universe is very different from the main market. In part, the companies themselves are younger and more agile. They're often involved in new trends, which are still growing, which have the potential to grow even when the world's in a recession. But most particularly, they're young and agile businesses, which can hopefully take advantage of the weakness of others to actually improve their market positions. And that's really the advantage of being listed. Yes, you can make money during good years in listed companies, but when you get to uncertain periods, such as we have now, where we're finding that it's quite difficult for companies to survive because of shortfalls of cash and customers, being quoted is a major advantage. And diversification extends far from just the sectors, but actually the companies themselves within the sectors. So you can see, for example, the technology company, the largest holding is a company called MTI Wireless, which is involved in 5G aerials, and it's got a technological lead, which hopefully will give it plenty of opportunities to sell many more aerials in the long-term future. But specifically, it's already a company which is generating cash. It's already got quite a strong balance sheet, and most particularly, it's paying dividends. Not all the companies in the portfolio are paying dividends, but it's interesting just to underline that many of these companies aren't speculative companies. They're companies where they're already moving into cash generation. Aferian is another example. Carrero is moving back into cash for the first time. Cyan Canode has announced many new contracts. So these are all different companies with different risk-reward ratios, and in diversified, and the diversification of individual holdings across the sector means that actually the risk is spread more significantly. If you move to the next slide, what you see here is that the way that we select companies is in a way driven by how much cash they're going to generate. As I mentioned, Cyan Canode came to market quite a few years ago. The share price has been quite weak. We've only invested it in the last couple of years. It's a business which is involved in networks, or it's called a network mesh. It's particularly good for measuring utility usage, particularly in emerging markets. It's got a very strong business in India, but also a number of other countries such as Africa and the Middle East. And most particularly, what you can see is the share price got to a very low valuation, having come down after issue, and we got involved when the valuation was very, the expectations were extremely low. And the reason we got involved is because we believe there's options for the companies to generate plenty of new turnover, and you need turnover to generate cash. And we really want companies which aren't just well positioned now, but are going to generate surplus cash in the short to medium term. We also need companies which are well positioned to pass on costs so that they can generate a margin. They can generate. Yep.
Could I just interrupt you and ask you to speak just a little bit more slowly?
Of course.
Yep. Thank you very much. Cheers.
That's fine. So going forward, the company itself is in a position where it's generating surplus cash on those sales, and as those sales grow, and it's announced a number of contract wins in the last 6 weeks, then as those come through, the business will not just move into a position where it generates profits, but it starts to generate cash in the next 2 years. We look for management teams which are well positioned to take advantage of the opportunities, but not overconfident. Overconfident management teams sometimes take too much risk, as far as we're concerned. We also look for management teams which aren't, which are careful not to rely on too much debt. Not all the things go according to plan. Sometimes they take a little longer. If you've got a strong balance sheet without too much debt, then you're in a position really where you can withstand periods of slow returns, and then you get the full upside without any dilution. There's no new shares need to be issued along the way. And the last point is we look for companies, I'm afraid we're very mean on valuations. We want companies where the valuations don't reflect the prospects. They reflect the history, as they do in this case. So those are the green lights we have. Specifically, these are our sell disciplines as well. So we find that when companies see a downturn in turnover, we're not going to generate the cash we expect. It's a sell. When we see companies which get caught out, perhaps with margins, that's a sell. Perhaps companies which have a balance sheet which is more geared, then that's obviously we don't want to take that risk. And obviously valuations which move high. This one, although it's moved up, still is not on a high valuation, hence it's still in the portfolio. So if you move on to the list of the holdings, this is the top 20 holdings in the portfolio. And I mentioned some of them already, but what you've got really is a wide range of companies. Many of these which are overlooked by the mainstream fund management community, particularly the professional fund management community, many of which are standing on what we consider to be unusually low valuations, and where, if they come right, it's not so much that the share prices rise, but sometimes as they become more popular and the valuations increase and the market capitalization increases, they become of interest to the mainstream fund managers, and as they get involved, they can drive up the share price further. So the opportunity isn't so much just about getting involved in companies which are going to hopefully succeed in the long term, but actually they're involved in companies where, if they succeed, the upside potential for some of these companies can be quite exciting. With that, the fund itself has had, generated a return of around 50% since issue. That's okay. It has been affected by Brexit, which has slowed interest in the bottom end of the market and added uncertainty. And most particularly in the last year, with the uncertainty about the slowdown in world growth, about the rise in bond yields, about the valuations of bonds coming down. Many stock markets around the world have come down, and specifically in the UK, a lot of UK small cap share prices have also fallen, even those companies which continue to trade well. And you can see that the underlying fund in NAV terms has come down some 25% since a year ago. That's all I was going to say about the fund right now. I was really wanting to talk a little bit about what happens next. This is a chart showing the correlation between US equities and US Treasuries. What this means is how much they move in sync with each other. And what you can see on the right-hand side is that actually the global stock market and the bond market have actually moved out of sync with each other for much of the last 25 years. And that, in our view, is related to the fact that demand has been very high, supply has been very high. China's been producing a lot of product. Eastern Europe, a lot of Asian markets have produced plenty of supply, and demand has been below supply, so inflation has been low. And every time we've had a setback, perhaps 2008, we've been able to inject demand without exceeding supply, and inflation hasn't risen. In fact, all that's happened is that bond valuations have increased, and that happened again in 2020. But 2020 was different, actually. It wasn't just that supply was up here and demand was increased. Obviously, supply was affected by COVID, and it was actually also impeded potentially by the Ukrainian conflict. So now we've got a position where demand is exceeding supply, and unfortunately, that does mean that we need to increase interest rates to bring demand back into balance with supply. And it's more like the left-hand side of this chart. And at that stage, you don't just find that actually stock markets go down, but also the valuations of bonds decline, the valuation of quite a lot of commodities have declined, the valuation of quite a lot of geared companies such as private equity have also declined. And this is causing a real problem because it's fine, having some things which are zigging and zagging, but if they all zig and zag together, it really does add a real question mark. And we think that the financial services sector is in really quite a difficult position because it needs to find genuine diversification at a time when actually the old globalization trade may be coming to an end. So if you look at the following slide, this is just talking about some of the risks. But if you look onto the following slide, page 13, what you can see really is that interest rates just add tension to the sector. They add tension to consumers who now find that they've got very substantial increases in energy prices. On top of that, and not often commented on, is actually the cost of accommodation is also increasing. If you were trying to rent a flat, you'll find that the cost of rental has gone up considerably in the last 2 years. And then if you've got a mortgage, of course, the mortgage costs may be going up with interest rates as well. So companies are coming under pressure. Consumers are becoming more price sensitive. Governments themselves are also coming under pressure because although they've got plenty of tax take, which might increase with inflation, of course, part of that tax increase, tax rates are actually used to pay for past debt. And as interest rates rise, the percentage of government expenditure taken up by paying debt, interest payments, increases. It increases from 1% to 3% of GDP, and it might go to 5%. So governments are running out of money. Yes, they're issuing quite a lot of extra cash and borrowing a lot of extra cash to kind of help us out in the short term. But the longer term feature is that actually there's more bonds in issue. And when there's more bonds in issue, you need buyers. You need the valuations to fall to bring in those buyers. So we are seeing an unsettled market. And that's likely to be the case with companies as well. They haven't seen the downturn as much as they're likely to see. But with interest rate rises and with banks being more cautious about lending, we are now beginning to see companies coming under real tension, partly because they can't raise new capital very easily, and partly because actually debt is quite difficult to raise as well, because the government's crowding out the ability to sell debt. And probably most worrying on page 14 is that if you look at the real money supply, this is after allowing for inflation, in the US, we are now looking, according to Andrew Hunt, which is an economist I rate highly, we're looking at a slowdown in real cash in the US. And the reason why the US dollar has been so strong is because actually the number of dollars in issue is actually declining. They're not lending overseas in the way they were. They're being more cautious. Many of the banks are selling bonds and those are being redeemed. So effectively, according to Andrew, we're looking at a really very tense period. And if we don't change behavior, I think the Fed will potentially drive quite a lot of companies into receivership. So I think we're going to see quite an unsettled period until the Fed changes behavior, which I hope will happen soon. So the bottom line is, if you look at page 15, is that I think we are looking really at a period when, just like Japan in 1989, it had a very big boom up to that period. And then thereafter, after 1989, yes, the markets have been unsettled. But most particularly, what was interesting about that period wasn't just that markets became unsettled, but nobody made any money in Japanese stock markets ever since. For the last 30 years, the markets haven't really appreciated beyond where they were in 1989. And in that regard, that's partly related to companies' valuations coming down because the cost of debt's come down. Specifically, so because the valuation of debts have been affected. Specifically, it's driven by margin pressure. Companies used to make big profit margins, and they make smaller profit margins. And most particularly going forward, in my view, I think China's moved ex-growth. So I think the momentum for generating growth by big companies is going to be much more unsettled going forward. And I think it's going to be very difficult to make money. So if stock markets don't go up going forward, how do you make money? And one of the ways about making money is a bit like the UK stock market, which itself hasn't risen. The FTSE 100 hasn't really risen much since 2000. And as you can see, in price returns, the UK stock market hasn't made a very good return at all. But when you include the income, and most particularly when you get the income and buy more shares with the income, particularly at depressed prices, then you get the compounding of income and you can generate an attractive return. And we believe that going forward, a lot of the professional fund managers will move away from capital growth strategies, which have been very successful during globalization, and they'll rebalance into cash compounding. And that's not just for those people who need income, but actually even those who don't need income, because if the stock markets don't go up, you still generate an attractive return by investing in companies generating cash surpluses. And this itself may be a really amazing opportunity, not so much just for the mainstream companies in the UK, but specifically for the UK smaller companies area. Most of the time I've been turning up to my clients and saying, we've got a strong opportunity, which we believe, hopefully in time, over the longer term, might generate a premium return relative to the mainstream stock market in the UK. But if the UK has been underperforming, as it has for the last 30 years, that's not a very exciting prospect. But what people don't remember is prior to the last 30 years, when there was a lot of inflation, actually the UK stock market outperformed not so much just Europe, but actually the US stock market as well. And that was related to the fact that when you're generating a surplus cash and there's a shortage of cash around the world, companies with surplus cash don't go bust so quickly. But much, much, much better, many of these companies are able to take over the companies which have gone into receivership. These are businesses in themselves which are over indebted. They go into receivership, they are sold free of debt, and being free of debt, they move into profit and generating cash surpluses. And so the mainstream companies can actually buy these companies and then generate a 3% improvement in earnings and a 3% improvement in dividends. So actually the outperformance of the UK stock market back in the 60s and 70s and early 80s was related not to the UK stock economy itself. The UK economy was in dire trouble in this period. We had the IMF rescue, we had 3-day weeks, we had 98% marginal taxation, we had the miners' strike. It was a very difficult period for the UK economy. But the UK stock market being different from most other stock markets, generating surplus cash, having the ability to issue new shares to take over companies, distress valuations and making extra return has outperformed. So in contrast to what we've been saying for the last 30 years, if we are in a strategy which can outperform the mainstream stock market, it's not so much we're made outperforming the UK market, but the UK market, if it starts to improve, as you can see on the right-hand side, as it happened in the last couple of months, the last few months to Stu, then it's not just the fact that actually we're making hopefully a premium return, but we're making a premium return relative to the stock markets around the world, international stock markets around the world, as well as the UK. So if you look at the following chart, how did small companies do in this period? And in that regard, what was interesting, this is going back from 1988 backwards, it doesn't include the last 30 years. Small companies have outperformed in the last 30 years, but as I say, that's been boring because the UK has underperformed and premium outperformance of a dull index hasn't been very interesting. But prior to the last 30 years, back in the time when inflation was a problem, lots of companies going bust, being listed was a huge advantage. One, you had a better balance sheet. But secondly, and really importantly in my view, these companies were able to acquire assets from the receiver. So what you saw is quite a small company acquiring a distressed asset, and the uplift wasn't 3%, but could be 15% or 30%. So what you can see in that light blue line is that actually the bottom 10% of the market, the small companies universe, outperformed considerably versus the mainstream market, which itself was one of the best performers in that period. Obviously, the real excitement for us is that green line. That's the microcaps, the bottom 2%, the companies below 150 million market cap. And as you can see, they didn't just outperform, they outperformed by quite a wide margin. And that's we've used logarithmic scales here, otherwise the numbers would look quite absurd. So if we're in a fund which is in the green line, and if we can add some value to the green line, and if the green line doesn't just outperform the blue line, the UK stock market overall, but actually the UK itself outperforms, we believe this is very upbeat for the potential for new investors to get involved in this area. And we believe there's going to be a sea change in attitudes, not just to the UK, but actually to the best performing parts of the UK, which includes small and particularly micro-cap quoted companies. But going back to the unsettled period I talked about earlier, if you look at page 19, as I said, I worry that there's going to be a lot of companies which are going to come under real margin pressure. Customers are going to become quite price sensitive. And when they become price sensitive, they're more likely to go around the corner and pay a lower price for the same service. How do we, as investment, Martin and I, choose stocks which are going to be more resilient in these kind of periods? And the way we do that is we don't just select companies which are well positioned in terms of investment to generate cash in the future, but also companies which have a real ambition to deliver outstanding customer service. And in that regard, when we meet companies, we ask about whether they have an ambition to deliver outstanding customer service, and they all say yes. So it doesn't add a lot of value, that particular question. Obviously, what we then follow up with will tell us how much of your board papers covers service data so that you can monitor it. And often they say something like 10 or 15 or percent of the board papers. And once they've agreed that it's in the board papers, we can then ask in more detail, well, tell us about the customer service standards last month. Which was the best performing part of your business? Which was the part of the business struggling a bit? How did it compare with the previous 3 months? How did it compare with last year? How did you get through when COVID was particularly bad? Have you done some mystery shopping on some of your competitors? And these kinds of detailed questions allow us to identify the management teams who really care about outstanding customer service, as opposed to those which are less certain about it. So the key issue is that by selecting companies which aren't just well positioned to generate surplus cash, but actually companies which are delivering potentially outstanding customer service, we believe that these companies will be less vulnerable to margin pressure. Yes, they may lose some customers to lower costs of competitors, but they hopefully will hold on to most of their competitors at attractive margins. The other feature, as I mentioned just now, is that we are worried that cash is falling across the global markets, particularly the US market. The strength of the dollar is affecting the valuation of markets. How do we manage the risk that actually all markets might have a sell-off? Well, we can buy a put option. So if you look at page 20, what is interesting from our point of view is that actually we can invest in an asset, a FTSE 100 asset, which tends to go up when stock markets come down. Now, the FTSE 100 hasn't gone down much this year. Small companies gone down further, but it's not. We've not entered a period of a particular setback. So we move to the next slide at page 20. What you can see there is actually the FTSE 100 option, which was extending initially to December 22. Hasn't added a lot of value. In fact, it's declined in value over the last year or so, but we've now got extended through to December 2023. It covers about 40% of the fund. What we saw when we saw the market setback, perhaps in March 2020, we had a put option at that stage in the fund, was not so much that it helped the asset value to fall less, it cushioned the fall of the asset value of the fund at the time. But much more importantly, as far as we were concerned, in March 2020, we could sell this holding for a multiple of its original investment price, and in so bringing cash into the fund, allowing us to buy more oversold small microcap quoted companies at very distressed valuations and adding further upside potential on the recovery. We don't know whether that's going to be any good. It hasn't worked in the last 12 months. It may not work up to December 2023, but it's only about 1% of cost per year. It's a bit like an insurance policy. It means that if you don't claim on your insurance, you don't get your money back. But it's very it's not correlated with the rest of the portfolio, and it can add considerable value going forward. So in conclusion, the name of the fund is the Miton UK MicroCap Trust. These are quoted companies. They have the ability to generate a premium return. They've generated a premium return over the last 10 and 20 years and since 1955. But as I say, that premium return has been relatively dull at a time when the UK stock market itself hasn't been very interesting. Obviously, if the UK market starts to outperform, as it has in the last couple of quarters, at that stage, we may find that professional investors start to become more interested, and most particularly not just allocating capital to the mainstream stocks, but start to move into the best performing parts of the UK stock market, and that includes not just small, but microcaps. And we expect many of the mainstream small cap fund managers who are mainly invested in many of the mid caps to move into small caps and ultimately into microcaps. And as that does so, we think that the opportunity for a virtuous opportunity where some of the company share prices start to appreciate because there's new buyers and there aren't enough sellers, may drive ultimately the long-term returns of the fund. Specifically, the fund trades around its NAV. It's a little bit below at the moment. That is related to the fact that actually every year we offer all investors on board at the board's discretion the opportunity of redeeming their holding. Why do we do that? Well, if you're thinking of buying some shares in the trust and you know there's an institutional shareholder who's potentially selling, you may not buy. If you give all the institutional shareholders the opportunity to exit, then clearly the opportunity to buy the shares isn't held up by overhanging sellers, and it means there's more turnover in the stock and it trades closer to NAV. The other feature about the fund is it doesn't have any performance-related returns. It's not involved in a benchmark. There is no benchmark. We're just trying to make best returns long-term, irrespective of what the benchmarks do. And on that basis, it means that although the fees are a percentage of the NAV, there's no special fees when we have particularly good years. The bottom line is that we're very excited about the potential for the strategy. We were excited when we first set it up. It has been held up a little bit by Brexit over the last 5 years, but most particularly now that we are seeing this period where inflation's come back, The opportunity for the UK to outperform, the opportunity for microcaps to outperform, for quoted companies to outperform because companies go bust, enhances their return. We're very upbeat about the potential for the fund in the future. Thank you very much indeed.
Thank you, Gervais. We've got a few questions to finish off with. So we will start at the beginning. Can we expect the trust to be much more volatile than, for example, a typical UK small cap portfolio, given the nature of its holdings? And how do you go about trying to at least keep some kind of control of that volatility?
That's a very good question. What's interesting about a lot of small cap share prices, particularly micro cap share prices, is they don't zig and zag very much. They don't trade very often. And so if anything, their volatility is relatively low. And then they have results. And when they have results, you get into a period where actually, of course, the share price might move at that stage in a volatile way. But by having about 130, 140 holdings, first of all, it means you diversify stock-specific risks and it reduces the ability of the fund to be volatile due to one or two holdings moving a lot. The second feature that we prefer companies with strong balance sheets, with the ability to generate surplus cash. We like to think of the fund as a sort of immature income fund. We don't get income from the fund because when the companies succeed and generate income, we tend to sell them and put it into other immature companies. But by doing so, actually, the volatility of the fund is less volatile than you might expect. I'm not going to say it's less volatile than perhaps the mainstream stock market or indeed mid-cap stock markets, but by having a long list of holdings, lots of different risks, diversifying, by preferring companies with strong balance sheets, it means that ultimately the fund, we believe, has less volatility you might think and still has all the upside of hopefully the microcap sector and hopefully adding a bit of value on top.
Thank you. Next one is, what's the largest weighting of a single holding, or largest weighting in a single holding that you would hold? And would you cut off when a company becomes successful, for example, which obviously is something you're aiming for, but do you kind of let go of the tiger's tail at a certain point, or do you just hold on?
No, we tend to we probably sell some of our winners too early. That's not because we like selling too early, but you can only really sell in volume at a time when the market's going up and there's more buyers than sellers. And if you sell after the top, perhaps the holdings moved up to 5 or even 10%. We've had some companies which have done that in the past. If you sell after the top, it gets quite difficult to sell, and there's not many buyers because they can see the momentum is negative. So we sell on the way up. The largest holding in the fund is about 3% at the moment, which is MTI Wireless. We have trimmed that along with others recently. But most particularly, we wanted diversification because many of the companies have a sort of option upside. And that's not just related to whether the largest holding. Some of the smaller holdings can sometimes do a transformational deal and generate very substantial returns. So a small holding can become quite a large holding through a transaction and then move very substantially. So the opportunity across the portfolio of having a large number of individual holdings means that actually, yes, we can still get a lot of the upside through some of those transactions.
Yeah. There's a question related to the size of the portfolio in terms of the number of holdings here, which is probably relevant to follow what you're just saying with. But it's what is the turnover of the sort of top 20 like when compared with the turnover of the whole portfolio? And also, why does the portfolio have so many holdings in it? What's the sort of what's the motive for that?
We tend to sell when we get a red light. So if you think to 2020, we sold we didn't have many consumer stocks, but there were some consumer stocks in the portfolio and we sold them all. We didn't have any Russian stocks in January, but in the diverse income trust, we had things like Polymetal, and we just became uncomfortable with the risk. It may be only 1 in 4, 1 in 5 risk that actually Putin started a Ukrainian conflict, but we didn't want to be holding a gold mine in Russia at that time. So there are opportunities to sell companies just because we feel less comfortable. But the principal reason for selling companies is one, either the share price has risen considerably and it's no longer cheap and we want to take profits. And we've taken profits, very substantial profits in things like Avacta and indeed Jubilee Platinum and such like, which would be very large holdings if we hadn't taken the profits. But alongside that, why do we have so many? Well, we're investing in microcaps. A lot of these companies are 20, 30, 40 million market cap. They're not just 100 or 150. And so if we said, we're only going to have 60 holdings for a fund perhaps of 100 million, that might mean that you need to put $1.5 million or something into each individual holding. And if you've got a £10 million company, that's 15%, and it's a smaller again. So the purpose of having a large number of holdings means that we can really invest in microcap companies, irrespective of how cheap they are and how small they are, and with the upside potential. And most particularly, it improves liquidity. If we need to take profits because we are getting worried about, perhaps a Ukrainian conflict or something, we need to increase cash. If you've got lots of individual holdings to sell, you can take profits, and at that stage, reduce the portfolio, but particularly build cash balances quite quickly without relying on liquidity of a relatively small number of holdings.
Mm-hmm. Just one more question about the kind of companies that you own. You may have touched on it already, but I can't remember. Would you ever invest in a company before it makes a profit? And are there any examples of that in the portfolio?
Yes, there are actually, and actually that's quite. It's not something which happens sort of all the time, but it does happen quite a bit. So if you look at the portfolio, for example, when we first put money into Syncano, which was the example I used, into that company has been unprofitable and it's now moving into break even and into profitability for the first time. Another example of that's Carrero, which is an internet denial of service attack thing, where again, they've got a deal with Juniper that boosted their sales. They're now generating cash, but that's only been recently. So yes, we do invest in some companies which are not generating cash, which are about to generate cash and hopefully generate, as I say, attractive levels of cash in the short to medium term thereafter. But most particularly, we're also very happy to invest in companies which are already generating cash, providing the valuation is very low. We are very mean about valuations. We're not paying up for companies, despite them being very good companies and perhaps rising. We're looking for companies which are overlooked. And when they succeed, it's not just that the share price improves, but the valuation improves. They become big enough to become of interest to the mainstream stock market, small cap universe. And as such, you get potentially a sort of an extra upside as a result of those selections.
I've got a couple of questions on interest rates and inflation. I think you've already answered the question about whether you're seeking to find companies which are resilient in the face of interest rate hikes and inflation. But if you want to expand on that, you can. But probably a more interesting question is, what analysis of companies' underlying debts do you undertake in light of the fact that they are obviously they respond to rising interest rates? And does that analysis extend to the underlying clients? So the companies that are paying them. How deep do you dig into how sensitive to interest rates your companies are?
Well, many of these companies are investing for the future, and as such, most of the companies don't have a lot of debt. Some have debt because they've done an acquisition, they're generating profits, they're generating cash surpluses already. But quite a lot of companies don't have debt, they actually have net cash already. But sometimes that cash is declining as they're investing. The area where we're particularly interested is investing in companies which are moving from cash flow out to moving to cash flow in. As I say, that ability for investing in companies which are generating surplus cash in the next year or two. So what we call that is last check. So when a company comes to see us, it's a good company, but it's got 2 or 3 or maybe 5 years before it moves into profit. In general, we're just not interested. It's not so much that the company's making losses in the short term and it's growing its market position, but there may be extra cash needed, and if the stock market's not in a good place or the shareholders aren't interested in writing checks at that stage, the company can fail, not because of the lack of success of the company itself, but the stock market mood. So we tend to invest in companies which are, if they are making losses, are moving into cash and actually cash surpluses relatively short term, next 2 years, perhaps 3 years at most. So from that point of view, that's the natural position. But coming back to your question about the world becoming unsettled, if you've got an unsettled world, you've got a company with cash, obviously it's more resilient, it's less likely to go bust, but most particularly they're likely to be caught out, all companies are likely to be caught out by bad debts. If companies go bust, there will be more bad debts. And companies with surplus cash or generating surplus cash are more resilient because they can take those bad debts and continue to invest in the business and grow over time. Quoted companies tend to have much less debt. Quoted companies, small microcap quoted companies, some of them have cash balances, and as such, we believe they're more resilient. But as I say, the real upside, the excitement for us, isn't so much about whether they have cash and whether they're generating cash, but the opportunity for doing takeovers of, unfortunately, businesses which have been over indebted, where perhaps free of debt, they're in a position to generate surplus cash going forward. And so you can buy them for a knockdown price from the receiver with the staff, keep the staff employed, and then get the full payback on all that previous investment at a much higher level. So people may have invested tens of millions in the business, and you're buying it for a knockdown price, and that gives you the upside. So that's the nature of the opportunity. We think that that's not been very relevant for the last 30 years, when many companies like zombies have been surviving. But if we are now in a period where companies are potentially going bust, we think that's particularly exciting, not just for the UK stock market, but also for microcap quoted companies specifically.
Yeah. And are UK smaller companies attractive as takeover targets from the US, considering the value of the dollar versus the pound at this point? And is this something you've seen in the history of the trust, where the pound is weak versus the dollar? Do you see takeover sort of affecting the?
We have seen some takeovers, and that's mainly industry partners who sort of wanted to buy a company with a market position which is alongside theirs, which can improve the combined market position, can improve. What we haven't seen is many of the the companies involved in private equity taking over these companies. In truth, they're too small. They want to take over Morrison's and those kind of companies, not these kind of companies. So coming back to that, the valuations have fallen partly because there haven't been many takeovers, and therefore there haven't been many share prices which have gone up. If anything, if we do get takeovers, we normally don't want them. Yes, it's nice to get a 50% premium, perhaps to where the share price was last week. But actually, many of these companies have, in our view, much greater upside than that. And it's the ability to invest in companies which have much greater upside over the long term, which is exciting to us. So we don't really want them to be taken over. We have had some takeovers. Generally, we voted against those takeovers. Most other shareholders have accepted them. We've been obliged to accept them in the end. But the opportunity really isn't so much from takeovers at this stage. It's from actually the valuation improvement. What you see, though, in time, if the world economy is much more much more unsettled going forward, big companies don't grow much. What we did see in the 80s and the 70s was many of the big companies used to buy small companies for growth. So they used to buy a little market sector which was growing because of subsector reasons, some structural reasons, and they wanted to be participating in that. It's already significant by that stage, and they could scale up enormously. And at that stage, you saw quite a lot of big companies paying premium prices for small caps. I think we are going to see that coming again, but it's far too early to see that at this stage.
Thank you. We've got a couple more questions on kind of economic stuff. Will the what seems like a continued push for the easing of listing laws by Liz Truss, etc., lead to an increase in innovative tech businesses in the UK, do you think?
Well, I think we will get more tech businesses, but I think we'll get more quoted companies. If you look at the last 30 years, the number of listed companies in the UK has actually declined, and it's declined in the US and other countries around the world. And that's because actually, for the last 30 years, you were better off with a private equity structure. Better off having debt, better off having lower cost of debt progressively. And many companies chose not to list, or many companies which were listed were taken over and put into an indebted structure. Going forward, we think that actually, when people recognise the advantage of being listed, the advantage of taking companies over at distressed valuations, the enhancement you can deliver from that, we think that actually the opportunity for being listed will be much more attractive. There'll be more capital there because it's not just the UK market which is outperforming, but it's more caps hopefully are outperforming the mainstream UK market. There'll be more capital from institutions, and that will fund many more issues. So we expect the number of listed companies over the next 10 years to be considerably larger than it is now, which is really counterintuitive because we're talking about distressed position, but that's when quoted companies with strong balance sheets, with the ability to raise external capital, are in a much more advantageous position compared with perhaps some of the very highly leveraged companies, private companies, in private equity companies.
Thank you. And one more on that kind of sort of macro and thematic front. Two of the biggest sectors, two of the trust's biggest sectors are healthcare and tech. These two areas were the big drivers of the last from the last market collapse, sort of the big winners out of the last market collapse, with the UK being a leader in life sciences and med tech. Could this be the next big growth trend / driver for the portfolio?
I think that will. I mean, the great advantage of some of these companies is that if you get lucky, you have a technology, you can sell vast numbers of those. So the sales can increase very dramatically without staff having to increase at the same kind of rate. So they're very operationally geared, and that is attractive. But what's really attractive from our point of view is being quoted in the UK, and particularly being in microcaps where most institutional investors aren't looking. It's their valuations in many cases are ultra. Well, we think they're very overlooked in valuation compared with perhaps some of the mainstream tech companies or some of the US tech companies. And it's that ability really to invest in not just companies which have the ability to scale up in size in the future if they get successful, but actually you're coming at a very low valuation. That's the excitement for us. That's why we've got those holdings. And many of them, as I say, like MTR Wireless and such like, are actually in a position where they're already generating cash. So if it takes a tiny bit longer to get the upside, it doesn't matter because the company's already generated cash. It's not going to be caught out by an emergency rights issue at a distress level.
Okay, nearly there. Two more. Penultimate is the UK market has proven resilient relative to its global peers. And do you still see the relevance in the FTSE 100 Putt option with a strike price of 6200 by December 2023, considering the FTSE is up at 7,200?
Well, you could have said that exactly the same thing back in December 2019. We just had Boris Johnson government elected with a large majority, the opportunity for Brexit in terms of coming to an agreement and completing a managed exit rather than a disorganised exit had improved. And then, of course, we got the unexpected. The pandemic arrived. So the great advantage of having the put option in there is that it actually doesn't cost much. It costs perhaps 1% a year. And you might say, well, actually, it's well out of the money, and that's why it's cheap, because it's well out of the money. But the great advantage of it is when we did see the pandemic, the FTSE went down to 5,000, and in doing so, we found that we're actually in a position where the company then not just had an option which had an extended term and volatility at that stage was 60 or 70, which increased the value of the option. But actually, although the option had fallen below 62 at that stage, back down to 5,000, it wasn't a big move. Clearly, it was adding value from that selection. So coming back to it, it may not seem that actually you can get a lot of value from these things, but actually the value lies in them being less correlated and specifically generating cash at a time when markets are distressed, so you get extra cash. The FTSE 100 itself isn't very correlated to the fund, and we don't mind that. Even if the market moves up a bit and the small caps move up a bit, it doesn't really matter. What we're interested in is things when there's a big setback in the market, and we saw a correlated setback in March 2020, not just in microcaps, not just in the UK FTSE 100, but international markets as well. And at that stage, correlation between the FTSE, microcaps, and most international markets becomes much, much higher. And that's the time when we want it. And the final thing about the FTSE 100 is that it's easy to sell. It's a conventional mainstream option. Therefore, we don't have to go back to the original bank we bought it from. We can go to a range of different banks. We can get competing prices. And that's kind of important in the middle of a crisis. We all didn't know where we can survive with the pandemic in March 2020. And we were just saying, can you give us a price for your put option at this stage? And there were some banks which weren't very interested in giving us a price, but there were others which were. And it's that ability to shop around and get a really good price. So most particularly, it's not just an ability to have a negatively correlated issue. It's the ability to generate cash and book cash profit at a time of distressed market. So yes, in the FTSE is a bit over 7,000. We don't know how far it's going to go down. If it does go down, but most particularly as it goes down, that term, the kind of the period through to December 23. As well as the 5,700, which is at the level at the moment, can both add value, and that was obviously very advantageous back in March 2020.
Thank you. Final question. There is one other question about the management fee and whether that's net or gross, which we can answer separately offline. So don't worry, we will come back to you on that, whoever asked that. But final question in front of the audience is, are you seeing any opportunities yet to invest the cash in the portfolio?
We've got a bit of cash in the portfolio. It's probably 6 or 7% at the moment, and that's we've been quite cautious about putting that capital in because whilst markets are falling, we don't need to rush. We don't need to rush our fences. There are opportunities, and we do see opportunities, but we're just holding back at the moment. When the market bottoms, maybe we do find that actually there's a change of policy in the Fed and they do become more expansive, or that we see lots of companies going bust in the UK, and the Bank of England stops raising interest rates, potentially cuts them because the number of companies going bust is too high. Well, if we see that, it doesn't take long to invest that cash. We can buy some of our existing holdings. We don't need to rush our fences, as I say. We can get that cash to work, within 2 or 3 days at the bottom. So yes, we are seeing opportunities, but we are being very, very careful about spending the cash in spite of that.
Brilliant. Well, that's all we've got time for. We made it. I thought it was very interesting. Thank you very much, everyone, for joining us and for taking the time to bear with us earlier in the week. And thank you, Gervais, for the same thing. And thank you for the presentation.
Thank you, Pascal. I mean, it's really interesting to do this. And if people have got feedback, please tell us, and we'll see if we can improve going forward.
Brilliant. See you guys.
Thank you very much.